For the last few weeks, I have been talking about the expected pullback in the markets that seems timely in its occurrence. As of yet, it really hasn't appeared. It makes one wonder what the stock market knows that most investors don't. There have been some landmines in individual names, given that earnings reports can be less than stellar at any given moment. But for the most part, we are seeing a greater than expected number of companies release positive earnings and guide higher moving forward than what had been expected. This has caused a number of pieces to be written in the press about the feared recession quite possibly being avoided and the interest rate cuts expected from the Fed being pushed from March to May or June, and even some talk of no cuts at all. It appears to me that the most important issue to watch is interest rates, and most specifically the 10-year U.S. Treasury, as it seems to be a quite reliable barometer of strength in the economy and a harbinger of inflation expectations. In the last few weeks, we've seen inflationary readings in the way of the CPI and PPI. Thomas Lee of Fundstrat has dug deeper and seemed to find that these higher than expected numbers could be blamed on spiking car insurance prices and a few other standouts. But the fact remains that the 10-year interest rate is now above the dreaded 4.2% interest rate level and moving its way back up to 4.5%. Here's the current history of this bond interest rate and some lines that show where it could be on its way to. Last week, I warned that there is a need to be cautious due to these rising yields. As seen here, the next stop would appear to be up around the 4.58% level. This is quite an increase from the lows seen less than a month ago, and therefore has a tendency to let a bit of air out of the stock market balloon. Continued economic strength seems to be the reason for this action. On one hand, this could be good, as it could mean that there is broad improvement in the global economy, ex-China and Japan. The global composite PMI indicated the strongest growth in 8 months last week, with leading indicators pointing to more upside in the coming months. According to Ned Davis research, reduced risk of a sustained global economic slowdown, or even worse, a global recession, supports the continuation of the cyclical bull market in global equities. They believe that, as I had stated earlier, the number one risk continues to be associated with monetary policy. What I mean by this is that the Fed is in a really tough spot. If they are late to party in cutting interest rates, this could cause the U.S. economy to have a greater propensity to enter some type of recession. But if they cut too soon, particularly with inflation measures continuing to show inflation's persistency, they could run the risk of cutting too much or too quickly and end up re-engaging another inflationary period. In considering the recession watch probability, it is clear that we are not entering a shockwave type of environment like the Great Financial Crisis or the pandemic, even though we have just gone through one of the steepest interest rate hike cycles in recent history. In the Wall Street Journal this past weekend, there was an article titled, "The U.S. Economy is Unlikely to Stumble." The article primarily focused on the retail sales report for January and how it was quite tame as compared to the CPI and PPI. They showed that food services and drink places continued to show increases and reflected an increase of 6.3% as compared to January of 2023. This again supports that point I continuously touch on, that there is still so much liquid, idle cash sitting on the sidelines. Prices are almost sure to remain high. I believe this has been the backbone of the resiliency of the consumer economy in the face of the Fed's tightening. Enough said about the two opposing fears, inflation and higher rates, or recession and economic contraction. In looking at the U.S. equity market, the two issues that I have touched on are the normal seasonal digestion that tends to occur after President's Day holiday and end in the later part of March, and the measurement of breadth of advancing market issues, where the small cap Russell 2000 index exhibits action, showing it joining their larger company brethren in the S&P 500. The Russell 2000 seems to be continuing to bump its head on a higher level, but can't seem to decisively move above this point. It could be that the regaining of energy in the S&P 500 might be necessary after its much-deserved rest. In looking at the broad market S&P 500, I think that the severe sell-off that was seen last Tuesday was some healthy profit taking, but not a sign of a significant market top. It is still too early to call any kind of a top for the first quarter. It would require a much broader and more inclusive decline. Interest rates could mean either that the economy is still plenty strong and therefore companies' futures should be respected, or that the Fed is in an impossible quandary where lowering rates could not be seen as the positive it is hoped to be. This week should prove quite interesting as one of the most highly followed semiconductor companies comes out with earnings just after you receive this note. All this being said, the last few weeks have not really given us a lot of new information to chew on. So I will leave you with the major points that we follow in determining our asset allocation decision. This is sort of a bullet point list of what we are currently seeing. I know that there will always be things popping up that can cause markets to change, but at present, these are the biggest issues that seem to be top of mind in today's environment.